Hi friends, if you've been investing in index funds such as Nifty 50 index funds, then you really need to wake up because there are a lot of index funds in the last 1 year has given more than 70%, 80%, 90% returns. And if you're thinking, Rahul, how can an index fund give 70, 80, 90% returns? Then this video you don't need to skip at all, because in this video, I'm going to pick up 3 index funds that have given more than 70, 80, 90% returns. And whatever I speak on this video is going to be data backed. And if you like that analysis, hit the like button and subscribe to this channel. With that, let's get going. Have a look at my screen and you will see very recently Economic Times published the top index funds that have given more than 50% returns in 1 year. And if you see, the top 2 index funds have in fact given 99% returns in last 1 year and 97%. And what you see common in these 2 top index funds is that both of them are value indexes. I'll explain to you one of them in this video. The second point you will see here is the index funds that have given between 76% to 71% returns. The second line here, and you will see all of these have something very, very common, which is momentum indexes. I will speak about momentum index as well in this video. That's my second pick. And the third one that I'm going to pick is not even in this list because possibly not many people even know about these indexes. It's going to be a super interesting video. Let's get started with the first index, which is BSE Enhanced Value Index Fund. Before I explain to you what this index is, let's have a look at the returns first. And if you look at my screen, you will see that the comparison of this index versus Nifty 50 index. And in the last 1 year, this index has given close to 92% versus Nifty's 30%. We have been in a massive bull run, but it has given close to 3 times more returns than Nifty 50. Look at the 3 years, it has given almost 3 times, slightly lower than 3 times than Nifty. Last 5 years, almost double the returns. No matter whether you take 3 years, 5 years, 10 years, 15 years of horizon, this index has outperformed Nifty 50 if you just take point-to-point returns. What about the SIP investing? Let's also have a look at that. If you compare the index SIP returns, you will notice that in the last 1 year, that has given close to 97% returns. 3 years, 51%, 5 years, 45% returns. These are all annual returns, by the way, and 10 years, 23% returns. This data is as of March 31st, 2024. Now let's also go a bit deeper and understand how this index performs during the bull runs versus the bear run. And for this, I'm picking up 2 bull runs. So the first bull run that you see is after COVID. So from March 20 to October 2021. And if we compare Nifty chart, which is the yellow line, and you see the enhanced value index, which is the candlestick pattern here. And if you compare the returns, you will see Nifty has given 142% returns in that period, while this index managed 140% returns. So both have given comparable returns in that particular bull run. What about the second bull run? Let me show you. The second bull run I am picking up, which is right now we are in. So from March 2023 to June 2024, Nifty has managed to give 37% returns, but this index has soared by 112%. Almost 4 times returns. Now let's also look at how this index has performed during the bear runs. And for that, I am considering 3 bear runs. Have a look at my screen and you will see the first one between October 21 to December 21, where Nifty was down by 10%. This index was down by 17%, right? So it has given more losses than Nifty 50. Have a look at the second one, which is from January 2022 to March 2022. Nifty was down by 13%. Yellow line is Nifty here, and BSEV was down by 5%. So in that particular instance, it managed to not give higher losses than Nifty 50. And the third one you see is from April 2022 to June 2022, where Nifty was down by almost 15% and this index was down by 21%. So I can conclude that during the bull runs, it is likely to give you better returns or comparable returns than Nifty 50. We have checked 2 bull runs. While in cases of bear run, it is likely to give you more losses than Nifty 50. So it is sort of a high reward, high risk sort of index. That is what I can conclude from this data. I haven't gone back to pre-COVID period because in my view, last 4 years of data is sufficient enough because the market dynamics after COVID in India has changed massively. And in my view, I'm very happy with that analysis. If you want to do more analysis, by all means, please do all your analysis going back to 10 to 15 years of time frame. So far, if you're enjoying this video, hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with content for you at 0 cost. Also, you can consider subscribing to my YouTube member community because I post in-depth exclusive analysis for my YouTube members covering mutual funds, indexes, individual stocks, etc., you will gain a lot of value out of it. Okay, Rahul, so explain to us how this index is constructed and how can we go about investing in this index. So allow me 3 to 4 minutes of time and I'll explain to you both these points. Point number one is how this index is constructed. So this index invests in 30 companies. How are these 30 companies selected? If you go to BSE exchange and pick up top 250 companies or stocks, this index will take 30 companies out of these 250 stocks. So essentially it is choosing large and mid cap stocks. Out of 250 stocks, it is selecting 30 stocks. So point number one is it is quite diversified. It's not only investing in the large cap stocks, it's picking up the large as well as the mid cap stocks. Now on what basis will it pick up these 30 stocks? So for that, have a look at my screen and you will see that it is going to pick up 3 value factors: book value to price ratio, earnings to price ratio, and sales to price ratio. Essentially what it is trying to do is it is trying to pick up those stocks that are trading at a low price, therefore their value factors are high, therefore they are much more valuable, they are attractive from a valuation perspective, and it is now constructing an index using those 30 stocks. So out of 250 index, it is basically picking up those 30 stocks that are looking attractive from a valuation perspective, and it is using these 3 parameters: book value to price, earning to price, sales to price. Of course, I have tried to oversimplify it. There is a lot that goes behind index construction which is beyond the scope of this video, but I've given you the gist of how the 30 stocks are selected out of the 250 stocks. In terms of sector allocation, right now if you look at my screen, as of May 2024, finance has got 32% allocation, oil and gas has got 30%, metal products, mining 24%, housing related 8%, and so on. So if this sort of sector allocation works for you, then you can consider this index as one of the options. So Rahul, what sort of companies are included in this index? So right now if you look at my screen, there are companies such as SAIL, REC Limited, Hindalco, Petronet, PFC, UPL, ONGC. So it has covered those stocks that are looking very good right now from a valuation perspective. Of course, this list will change as and when the index get rebalanced. Now comes $1 million question: how to invest in this index if one wants to do that? There is only right now one Motilal Oswal's index as well as ETF available. Both options are there. And if you compare index fund of Motilal Oswal, you will see that it has given in the last 1 year 93.82% returns. If I compare that with the ETF, it has given more than index fund, which is 96.91% returns. And if you look at the since inception, this ETF, which I think started back in August 2022, and if you compare that as well, if you see since inception 22nd of August 2022, the index fund has managed to give 64% CAGR, while the ETF has given slightly more, 3% more, 67% more. But in my view, index fund is a better route. Let me explain to you why. Because if you go and have a look at the volume of the ETF that is being traded, it is only 0.32 lakh, which is only 32,000 on a daily basis. So if you're looking to invest a lot of money, then liquidity might be a problem. It is not a very liquid ETF compared to, for example, Nifty Bs and things like that. So if market crashes, then what happens is if you want to sell your ETFs, then you're not likely to find buyers, and therefore you might need to sell it at discount level. This is the disadvantage of going with ETF. But at the same time, if you go with the index fund, the returns are less. So the choice is yours, but in my view, I would prefer index route because of the liquidity issue that I just explained to you. Second index fund that I want to speak about, which is not even included in ET's list that I spoke about earlier in the video, is Nifty Alpha 50 Index. And I talked about this index about a month ago on my YouTube member community. And if you see my screen, in the last 1 year, this index has given close to 80% returns. If you look at the last 5 years, then this index has given close to 35% returns, while since inception, if we compare this index, which was from 2012, the index has given close to 22.59% returns. Compare this with Nifty 50. Nifty 50 in the last 5 years has given 15% returns, while this index gave close to 35% returns. So almost double, more than double. And if you compare since inception, how much Nifty 50 has given, close to 11.51% returns, while this index has managed to give 22.59%, again almost double the returns than Nifty 50. What about bull run? What about bear run? So I have taken one bull run and one bear run. So have a look at my screen. In the recent bull run that we are right now from March 2023 to June 2024, Nifty has given 33% returns, while Nifty Alpha 50 in this same period has given 108% returns, almost 3 times returns. What about the bear run? Have a look at bear run. I have taken one example, but you will find exactly the same situation everywhere, which is from April 2022 to June 2022. Nifty was down by around 14%, while this index was down by 35%. More than twice it was down by. So the conclusion is very simple here. During the bull runs, Nifty Alpha 50 will give you higher returns than Nifty 50, but during the bear runs, it is likely to give you more losses than Nifty 50. So again, it is the same type, which is high reward, high return, not suitable for everybody, but over a longer period of time, what we have seen is it is given better returns than Nifty 50. Okay, Rahul, what is this Nifty Alpha 50? Can you explain to us in a 1 minute simple commentary? Very, very simple commentary. Imagine top 300 stocks listed on NSE by market cap. Out of these 300, if you ask me, Rahul, give me the best performing stocks and I will only invest in those. So I will take the factor, which is alpha, and I will arrange these 300 stocks by alpha factor, and I'll give you the top 50 stocks. These 50 stocks have given much higher returns than the index returns. Therefore, they have generated higher alpha. Again, please do Google about alpha because there is also a risk angle to it. But all in all, I won't cover this in this video. Otherwise, this video will get really, really long. But the point is simple, that these 50 stocks are selected from top 300 stocks. So it is selecting the top 100 large stocks, then next 150 mid cap stocks, and then going to the 50 small cap stocks as well, and picking out those 50 stocks that have given the best alpha return in the last 1 year. So basically, you're riding on the momentum here. The theory here is that if these stocks have performed really good in the last 1 year, if they are likely to continue to the momentum, then this index is going to give you good returns. That's why in the bull run, we have seen that the index has performed better, but during the bear run, the index has come down. Okay, Rahul, next question. What are our options to invest in this stock? If you want to invest, there are two options for you. One is, from an ETF perspective, there is only one ETF, which is Kotak Nifty Alpha 50 ETF, that has given close to 79% returns, almost matching the same index returns here. This ETF started back in December 2021, so about to complete 3 years now. AUM is around 154 crores as of May 2024. And if you see the comparison of Nifty Alpha 50 index versus Kotak Nifty Alpha 50, yellow line is the Kotak one and the blue line is the index. You will see that it has given slightly lower returns than the index itself, because of course there is always going to be a tracking error. And if I show you the data since its inception, it has given 21.33%, while Nifty Alpha index has given 3%, almost 3% more returns. And in the last 1 year, if you see, it is 79.21% versus 81.77%. The expense ratio of this ETF is slightly on the higher side, 0.30% versus like Nifty Bees, etc., which is at around 0.80, 0.10, etc. The second option to invest in this index is Bandhan Nifty Alpha 50 Index Fund. It is not an ETF. It is an index fund. It is a recent one, started in November 2023. AUM is really small right now, 45 crores only right now. And from a returns perspective, in the last, I would say almost 8 months, November 23 onwards, it has managed to give 48% returns. So I would say similar returns, not very high, not very low. But again, this is a very new index fund, while the Kotak one has been out there in the market for almost 3 years now. Friends, I hope so far you're enjoying this video. And if you are, please hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with such content more often at zero cost for you. With that, let's move to index number 3, which is Nifty 200 Momentum 30 Index. In the last 1 year, this index has managed to give around 68% returns. And if you go back to 18-20 years of history, the blue line that you see is this index versus orange line, which is Nifty 200, and the gray line, which is Nifty 50, you will see that this index has given far better returns. And from a CAGR perspective, it is given 20.6% returns over this long duration versus Nifty 200 14.7% and Nifty 50 14.7%. Why we are comparing with Nifty 200, I'll explain to you in a minute. But more importantly, if I break down the last few years returns, you will see last 1 year, last 3 years, 5 years, 7 years, 10 years, in all the time horizons that you could consider, Nifty 200 has given better returns than Nifty 200 as well as Nifty 50 TRI. Rahul, what about the bull run? What about the bear run? So have a look at my screen. In the bull run, if you see the mega bull run that we have right now from March 2023 to June 2024, Nifty 50 has given 35%. This index has given close to 90% return. So more than double the returns that it has given. In the bear run, if you see this massive bear run we had from October 21 to Jan 2022, Nifty 50 was down by 17%. This index was down by 26%. Again, this is more riskier when it comes to bear runs. So please be aware that it's a high reward, high risk sort of an index fund. If I speak about another bear run, if you see December 2022 to March 2023, Nifty was down by 10%. Momentum was down by slightly more, 12%. Okay, Rahul, how is this index constructed? So very, very simple. If you see, it takes the top 200 stocks listed on the NSE Out of that 200, it is going to pick up those 30 stocks that are showing the best momentum. Momentum is slightly different from alpha. In alpha, you are generating additional returns on top of a benchmark, while in momentum, you are looking at the absolute returns that the stock has given. So here it is picking up those 30 stocks that have given the absolute price returns divided by the standard deviation. Again, don't go into too much of complications of how the Z score is calculated and things like that. Just for simplicity, understand that it is going to pick up those 30 stocks out of the top 200 that has given the best returns in the last 1 year. And the theory remains the same, that if these 30 stocks continue to outperform the remaining 200 stocks, then you are going to make more money than investing in the 200 stocks as a lump sum. Okay, next natural question, how do we invest in this index if we were to? So you have two routes. One is the ETF and another is the index funds. And I did a detailed post on my YouTube member community few months back on this particular index. And my conclusion there was that if you go down the ETF routes, the key issue remains the liquidity. Liquidity is very low. In fact, one of the oldest ETF was showing me around 14,000 of volume on a particular day, which is not very huge. So in case the market crashes, you might end up selling this. If you were to exit, you might end up selling this at a discounted price, while that is not the case in the index fund. And if I talk about the index funds available to invest in this particular index, there are total 5 that I could find. If there are more, please let me know in the comments. These 5 are listed on your screen. I've arranged them in the order of the oldest one. So UTI is the oldest one, followed by Motilal, Bandhan, Kotak and ICICI. Look at the AUM perspective as well. UTI has got the highest AUM. From a returns perspective, UTI has given the best return, 69.79% returns in the last 1 year. CAGR2 is 27%. The expense ratio of UTI is the highest here, 0.46, but please be aware that these returns are net of the expense ratios. So although it has higher expense ratio, the returns overall are slightly better than Motilal, but Motilal is not far away. The AUM is slightly lower and it is also around 2-year-old index fund. I've given you a lot of details about these index funds. Please go and do some more analysis and take your own bets. Now, please let me know in the comments any other topics you would like me to create videos on. I would highly recommend you to now watch these 2 videos. They are extremely important for your investment journey. And if you like this video, hit the like button. I'll see you in my next video. Until then, keep rocking.